Hello everyone, welcome to a new video. In this video, we are going to look into a fifth chapter of the book Stocks to Riches, written by Parag Parikh. The first four chapters have been covered in the earlier videos. Those who missed those videos can go back and watch those videos first and then come back here. And where we have discussed the topics like investing, investment strategy, 3 ways of investing, and introduction to behavioral finance. We have been discussing the last 4 videos, and in this video we are going to see a 5th chapter, which is nothing but loss aversion and sunk cost fallacy. This video was created in such a way that the viewers get a lively book reading experience. Hope you guys enjoying the experience. So let's go into a 5th chapter, loss aversion and sunk cost fallacy. First, let's understand what is loss aversion and sunk cost fallacy. Feelings towards losses can be of 2 types. One is loss aversion and the second is a sunk cost fallacy. Similarly, loss aversion is nothing but the fear of losing something, and the sunk cost fallacy is the inability to forget the money that has been already spent. Earlier we would have made an expenditure and we would make the decision based on the money which is already spent. Similarly, feelings towards gains has been divided into 2 types. One is the status quo bias and the other is the endowment effect. Status quo bias is nothing but the inability to make decisions because of the profit or because of the happiness which we are at that time. And endowment effect is nothing but tendency to fall in love with what we want and resist change. We being comfortable in a zone and we feel like avoids a change which might be necessary. So out of all things, the thing which we wanted to do is do the right thing that has to be done irrespective of losing, irrespective of the money already spent, making the changes that are needed, and most importantly making a decision that had to be made, irrespective of situations that we are in. So let's see let's go into loss aversion. First topic. So loss aversion is a very important topic to be known for stock market traders and investors, because when comforted with sure profit, we become conservative, but at the same time when comforted with a sure loss, we tend to take more risk, because no one likes losses, right? Everyone wants profit. We don't have a accepting power to take losses. That's a main thing. And because of the pain of the loss is 3 times more than the pleasure of equal amount of gain. If we take equal amount of gain and equal amount of loss, but the pain in the losses are greater than the pleasure in the gains actually, even for same quantity. Over time, pain becomes terrifying and pleasure becomes boring. If we make on profits, it's become boring, but if we make on losses, it's terrifying, right? And accepting losses is also part of investments actually, and it is very important to accept and book it when at the right time, so that we can able to make sure we make losses, and when we make losses, they are small, and when we make profits, they are really big. This is a very important concept which we need to understand. What are the impact of loss aversion? The second topic is impacts. Yes, we understood loss aversion. What are the impacts? Parag Parikh talks about 5 major impacts. 1. Investors tend to prefer fixed income over stocks. Yes, because of the fear of loss aversion, so fear of losing, people tends to go towards fixed deposits, because it gives a fixed income, because stocks are a little risky. Investors tend to take their profits very early. When the profit comes, we book very early very early, and we come out of their positions. Investors take more risk when threatened with a loss, but in case of losses, we don't book and we average our position. Investors tend to hold on to the losers and sell winners. By doing this, we might be holding the losers, which is making losses, and selling the winners, which is making us profit. Tax evasion. People are always worried about paying taxes, right? Tax is considered as a loss, but in reality, we pay tax on our income. So it's really essential we need to change the mindset here. So coming to a third topic, the sunk cost fallacy. Yeah. Increasing your commitment to justifying your past action because your ego is tied to a commitment. Exactly. Since we already made a decision and it's a effect of the current situation is the effect of the decision, we just keep on holding the decision which we already made and act upon it actually. Let's take an example. Let's assume we have pre-booked a ticket for a new movie for 1500 rupees, but on the day of a plan, let's assume there's a severe rainstorm and even the threat of cyclone. Would you still go to a movie? If your answer is yes, the decision makes no sense because the 1500 which is already been paid actually, and whether you go to a movie or not go to a movie, the money is not gonna come back irrespective of what we do. But we face the fear of, but there might be a possible situation where we might stuck in a rainstorm or cyclone, so we should make a note of it. Sunk cost fallacy. This is exactly what sunk cost fallacy, and sunk cost fallacy can also help in a positive way. Like earlier we took an example of negative way, but it can also help us in a positive way. Example: a person joins a gym by paying the whole year fee. Let's assume what it does is, even he might be little lazy or irregular, the sunk cost fallacy would help him to be regular because he thinks he has already paid the whole year fee to the gym, so it will be a loss, so he should go regularly. So sometimes it's really important to make a negative into a positive. So sunk cost fallacy can also be used in a positive way. So fourth topic is nothing but impact of sunk cost fallacy. What are the impacts? Parag Parikh talks about three major impacts. First is the averaging cost of purchase. Yeah, exactly. When you buy a stock, when investors go wrong in the purchase of stock, they buy more at every fall instead of booking the losses and getting out of stock. Yeah, this is one of the mistakes which we do. Spending on repairs. Sometimes it is wiser to buy a new car instead of spending on repairs every year if it reaches the end of its economic life. Right? Government spending on unviable projects. Sometimes bureaucratic procedures would have delayed a project and it has become less viable right now. But since the project has been sanctioned, the money has been raised, so the project will be completed even though it may be not viable. These are the impacts of sunk cost fallacy. Let's go into a fifth topic, getting out from under. To find out whether you are a victim of loss aversion and sunk cost fallacy, let's answer these following questions. Do you prefer fixed income over securities of the stocks? Are you tempted to move out of the markets when the price falls? Let's assume you are investing some amount. If the price falls tomorrow, or you tend to move, or you fear of moving outside of the stock. Thus, your portfolio consists of a few winners followed by a long list of losers. Do you sell your winners fast, but hold on to your losers? Do you make important spending decisions based on your past spending, the way how you spent it earlier? If your answers to all the questions or most of the questions are yes, then you are a victim of loss aversion and sunk cost fallacy. And the upcoming suggestions in this chapter would enable you to make wiser investment decision in the future. So what are the suggestions? First suggestion is check your appetite for loss. Losing money than actually you think. Yeah. This will help you to avoid making decisions that you will regret later. Your earlier success may not necessarily mean that you have made a smart decision. It is important to assess your level of loss aversion and risk tolerance to improve your ability to make smart investments. Ask yourselves whether you will exit the stock market at the first sign of trouble. If tomorrow, your stock down by 10%, will you go out of your position? Or if it is 20%, will you go out? Or if it is 30, or if it is 40. So different persons have different level of risk appetite. So we should find what's our level. Consider following situation: you own rupees 1,50,000 worth of TCS stock, which you bought for 1 lakh rupees. And similarly, right now you also own 50,000 worth of Infosys stock, which you bought for 1 lakh rupees. And you need rupees 50,000 urgently. Which stock would you sell? If you choose to sell TCS, which is already in profit, then most of us then you are also like most of us suffering loss aversion, which makes you to sell the winners and hold on to the losers. The right decision would be like selling. The best strategy under these circumstances would be to sell half of each and avoid paying taxes too. So the second advice would be diversify within asset classes and across assets. What Parag Parikh says about diversification is the best way to avoid the pain of losing is to avoid actually losing. Yeah, exactly. If you don't lose, of course there won't be any pain, right? So, but the problem is there is no foolproof solution to that, but there is always chances to minimize the losses. How we are going to minimize? One, need to not only diversify within asset classes but also across different assets. A portfolio of equity stock can be diversified by limiting an individual stock exposure to about 10% actually. Whatever the stock may be, either it may be the best stock in the world, but our allocation of fund for that stock should be only 10% of it. Second, limiting industrial exposure to around 20%. Fine, we are investing in one industry like IT. We should not just invest only in IT. So maximum we can able to invest 20% of our whole portfolio in IT actually. And the fourth is all the wealth could be distributed between stocks, bonds, real estate, gold, mutual funds. Exactly. Instead of only buying stocks, we can invest, diversify our investments in different things like all these things. A loss in this way, if we do a loss in one asset could be offset by a gain in another. Exactly. So there will be a balance in our portfolio. So you are less likely to react emotionally and act foolishly on impulse. As discussed earlier, taking an overall view of your portfolio helps to avoid loss aversion traps. The next service is total portfolio vision. Exactly. Avoid looking at gains and losses in isolation and train ourselves to look at individual investments as a part of whole portfolio. What does this mean? One stock may be at low, but the contrary other sector stock should be in high. So we instead of seeing the one negative stock, we can see our portfolio as a whole. But this requires real discipline actually. We can't able to easily get that, but we can work on it. And second is, it's important to have a solid investment philosophy and a strategy, and more importantly, put our information reports on the spreadsheet to get a bigger clear picture. The next advice will be put the investment plan down on paper and determine the portion of portfolio to be invested and the rationale behind doing it, why we are doing it. Exactly. Writing it down increases your commitment to follow the course. Yes, and actually if you do this, we also take the benefit of sunk cost fallacy. So use sunk cost fallacy to your advantage because you are committing yourself to your plan. Since we have a reason to enter a stock, of course we will use the sunk cost fallacy to our advantage actually in here. When you identify your goals and justify all your investments in the context of achieving those goals, then you are less likely to react to ups and downs of the markets. Interesting, right? The next advice is let bygones be bygones. Yeah, leave your darkness of the past behind so that you can focus on letting the light of your future. Exactly. Very often our decisions are weighted down by our past actions. It is best to forget the past. That is easier said than done. If financially you can let bygones be bygones, you will be much better off for trying. For example, suppose you are debating of a sale of an investment. Let's assume you are considering an investment, considering a sale of an investment, a house or a land. What is important is the worth of an investment today, not the day which you bought. So according to the worth of today, we might think how to sell it, when to sell it. Not since I bought it for 1 lakh, I should sell it for 2 lakh. That not should be a course. Your goal should be maximizing your wealth, not justifying your purchase. Exactly. You need to evaluate the investment based on the current potential for future gain or loss. So instead of looking at the purchasing amount, we should look at the current value actually and make our decisions accordingly. The next advice Parag Parikh gives is reframe losses as gains. How losses can be made as a gain? Very interesting, right? Let's see. So he advises to keep an eye on our financial situation. Losses are tax deductible. Yes, losses we can able to save taxes if we make some losses also. Master your loss aversion quality. How? So we can evaluate our investments by keeping an eye on our financial situation, and since losses are tax deductible, we can adjust our losses against our gains so that we don't pay higher taxes, and make potential losses as gains. How it can be done? Yes, we all know the proverb, right? Failures are stepping stones for success. Exactly. If a valuable lesson learned from that loss, then of course we have made the potential loss as gains, right? Exactly. We should learn a lesson from the mistake which we done, from the loss which we occurred, so that we never repeat the same mistake again in future. That is also a gain in the long term. The next advice is segregate gains and integrate losses. What does this mean? Parag Parikh says to book profits in parts. The reason behind doing it is to multiply your happiness and divide your pleasures. Exactly. When we divide our profits, we will be more happier at the more instance. This is called Weber law, where the pain of two moderate bad experience will typically exceed the pain of experiencing both at the one time. So when we book loss, we can book as a whole, but when we take profits, we can book partly. And the next advice is pay less attention to your investments. Exactly. Parag Parikh says for investors who do not trade, we can see when market volatility is on the rise, more frequently we check our investments every now and then, how much it has ranged, how much it has gone down. But since and of course if we see, we will try to react, or we might react. So for investors who do not trade professionally, it is good if they see a portfolio once in 6 months. Yes, in this way you might miss one dip or one rise, but it is really good trade-off against peace of mind. We might have a really good peace of mind. So these are the different advices which Parag Parikh gives in this chapter, and this is the references which he used to frame this chapter. And fear and greed are two sides of the same coin. We have seen how fear affects us when we face with losses, right? Similarly, if you have learned something valuable from this video, just click the like button and subscribe to the channel to watch the next video, where we will be seeing the next chapter to understand the behavior where we face with how we face with gains and the greed that drives us. When we face the greed and gains, how it drives us. Until then, it's a bye from Bhala.